All right, fellow AMC stockholders, XMAX Trading here. I want to go over some latest DD, some secret information I was able to get from Seeking Alpha. It's behind a little paywall, but it became available, and it's a pretty interesting article about AMC. I know the stock price has come down a lot today. It sucks. But, this would be the dip for the rip. This does happen. So we got to hang in there, hodl gang, and get through this. But pretty interesting DD. Hit the subscribe button if you haven't already. Hit a like button. Subscribe to the channel, and let's get started. So, from Seeking Alpha, why I am buying AMC's debt. AMC has recently been able to capitalize heavily on its meme stock status and short up its cash position rather substantially. AMC has been recovering well in the past few months and is set to return profitably next quarter. So, probably this quarter, right? Fourth quarter. Maybe it's talking about first quarter next year. I don't know. While there is still a ways to go before it's in healthy cash position, AMC is in a suitable position to justify investing in its bonds. AMC was in dire need of capital in the early stages of the pandemic, so it sold bonds with high yields and coupon rates in order to attract creditors. Now the company has been able to reduce its risk of defaulting. Investors can take advantage of the high yield, underpriced loans with a bit more confidence. I do much more than articles on EV supply chain. Okay. Earlier this year, as I'm sure most readers are aware, AMC got caught up in the Wall Street's bets mania that took the retail investor by storm, reaching a peak of $72 back in June. AMC is now way back off its highs, but still fairly elevated at $33. This isn't an article meant to analyze the new price as the new norm. I really don't think that there's a case made for that. Instead, I'll be looking at some of AMC's available bonds in increasing order of security and why I believe there's some of the most attractive securities in the market right now, especially for income investors. Likelihood of payout. Before I look at bonds themselves, I understand the security or the potential lack thereof that they offer is important. Bonds themselves, so maybe they're not as secure as we think they are, I guess. Having lost $4.6 billion last year on $149 million before the COVID era. Having lost $4.6 billion last year during COVID and $149 million before COVID, it may seem ludicrous to even consider the fact that AMC is a good bet for creditors. However, the company took full advantage of its meme stock status and raised significant funds off the back of an incredibly inflated valuation. Even before the company earned its meme status, AMC raised $917 million from mid-December to late January. $506 million of this came from the sale of new equity, and the company was able to convert $100 million in second lien debt into equity as well. AMC was also able to convert $600 million in senior notes held by Silver Lake into equity. The company has also raised raised $1 billion from April to November from previous year through equity and debt raises, as well as a modest amount of asset sales. These early capital raises enabled AMC to become a bit better equipped to handle existing debt load in light of the previous year's poor performance. However, all this together is not really strong enough. Then in late January, things changed. Trading around $5 on January 6th, shares would rise up to $20 the following day. So short squeezes happen in a day, guys. You got to think about that. It could be a day, a couple days. It could happen really fast. While they soon retreat from such highs, shares sustained an elevated trading level until late May, and then shares broke the $60 in a matter of days. So we are at kind of a sustained elevated level right now. We kind of dipped below $30 today. But maybe we'll go back up, hopefully. This new price presented AMC the golden opportunity. While the company waited to fully seize opportunity, while the company waited a little to fully realize the opportunity, AMC raised a total of $1.246 billion in the second quarter, all in equity, which was such an elevated stock price. AMC was able to raise far more money than it would have been able previously and at a far lower level of dilution. After this more aggressive round of funding, AMC CEO Adam Aron said the raise has essentially strengthened and improved AMC's balance sheet, providing valuable flexibility to respond to potential challenges and capitalize on attractive opportunities in the future. The last part of this I find particularly interesting, as it implies AMC may even have some excess capital to invest in particularly attractive opportunities presents itself. While I'm not sure if AMC is quite in the position to begin spending money on new opportunities again, it does speak towards the confidence in the company's current capital structure. Even for this incredible capital raise, Mr. Aron was rather pleased with the company's standing, saying, "I'm optimistic and confident about AMC's ability to weather the COVID-19 storm. Our focus is no longer on survival." The executive's remarks made in March even came before the strong rally in June. This level of confidence coming from the company's largest capital raise provides even further reassurance. But enough of this discussion of sentiment. With all this recent movement, what exactly is AMC's cash position? So here it is, AMC's cash position, liquidity ratio, quick ratio, debt management asset, debt to asset ratio, debt to equity, market gross margin, operating margin, liquidity, AMC, historical ratios, peer comparison ratios. Examining the company's liquidity ratios, AMC unsurprisingly isn't terribly well positioned. The company's current ratio, which measures current assets to current liabilities, has trended below 1 since the data became available. The quick ratio, which excludes inventory from the measure, has never reached 1 as far back as the public data goes. While the inventory is typically considered rather liquid, it can require significant time to convert into cash, hence the quick liquidity ratio. A ratio of 1 or above signifies that a company's easily liquidable assets are able to cover all the short-term debt obligations. As AMC does not have a current ratio, or quick ratio for that matter, above this mark, it cannot simply rely on easy liquidation and current cash to cover short-term liabilities. Similarly, looking at the company's debt-to-asset ratio, we can see the debt dramatically outweighs the company's assets. Look at the historical ratios for AMC, we can see this isn't fairly new either. While this is unsurprisingly increased a lot over 2020, the company has historically high debt-to-equity ratio. This signals that AMC has largely relied on debt through its lifetime to grow its assets. This heavy use of debt is the main culprit behind AMC's weak capital position and concerns of bankruptcy last year. Though the fact is that nothing is new, should tell investors that the high debt-to-asset ratio is inherently a bad thing. It's not a bad thing, guys. There are other companies that have high debts but also have high revenues, and they are profitable, and their stock price can rise. The theater business is a very capital-intensive business, and not utilizing debt in this manner would make expansion incredibly difficult. What is noteworthy, however, is exactly how high this inflated ratio has become. In 2020, AMC's debt to equity ratio turned negative for the first time, signaling the company's liabilities surpassed its assets. Often, companies with such predicament face insolvency, as they're faced with inability to make good on debt obligations. However, this is the end of 2020. We'll have to wait for AMC's full-year report to see how this has changed. Through the company's lowering of debt and dramatic increase in capital through stock sale, it should return to positive in 2021. It should return to a positive 2020. If you look at the company's current market value of debt ratio, we can see that AMC's equity position at the moment is incredibly strong. At 0.63, AMC is actually in a position to fund its debt obligations through equity. Incredibly strong. We can see that at the moment it's incredibly strong as the truth is from merely struggling to stay afloat. At 0.63, AMC is actually in position to fund debt applications through equity. That's down dramatically from 23.87 at the end of 2020. Though it's still quite a bit above 1. Above the 0.1 average for U.S. firms. We know the AMC isn't the pinnacle of financial excellence at the moment. The entire reason for this article exists. What is important to note is that the company's financial health is rapidly improving. What is important to note is that the company's financial health is rapidly improving. I don't think there's such a question that there's no much of a question AMC will sell more equity before defaulting. A solution is far less damaging than defaulting on debt would be. AMC has been prioritizing debt payments through its recovery, and there's no reason they would stop now that it has even greater means to do so. While the majority of these figures don't necessarily indicate the most financially healthy company, it does indicate that the company is on the mend and has eliminated concerns of insolvency. So the main high debt load is not anything new for AMC. It's higher than usual, but not atypical. More importantly, AMC was missing income. As consumers return to theaters, income begin to return to normalcy. Return to normalcy, looking at the numbers, doesn't really paint a great picture of AMC. However, the numbers don't tell the full story. Operational success is how companies handle these matters. AMC is starting to exit the most challenging operating environments of its life. As the world begins to return to normalcy, its cash position will improve dramatically. The cash position will improve dramatically. To start this off, let's look at some seeking alpha analysis of AMC. return to normal with exclusive releases from Disney, and Cineplex and Cinemark offer similar conclusions they'll return. In the above articles, theater business, I believe it's safe to say AMC is on the road to recovery. Now I accept the AMC still has some way to go, but it's definitely on the mend. More recently, AMC released its third quarter earnings. The company lost $244 million off of $763 million revenue. The profits here, the company's revenue climbed 71% over the previous quarter. Keep in mind, this doesn't account for the high-profile releases in October, such as No Time to Die and the second Venom title. Upcoming Spider-Man and Matrix movies should only expedite the company's recovery in the final quarter of the year. Corporate leadership is currently guiding towards a positive EBITDA in Q4. Moving on, it looks like AMC's net margins through years, as the figure demonstrates, AMC has been turning out a business global net margin for a decade. This is normal that AMC is working so hard to return to. After AMC has hit its level of expensive debt, it now needs to do more than just return to normal to successfully pay it off. AMC's corporate borrowing has risen from 4.7. Corporate borrowing has risen from close to $5 billion to more than $5 billion. The good news, if anything, is that AMC's corporate borrowing marks a $250 million decrease from the ending of 2020. What caught me by surprise is the company's interest expense on corporate borrowings was only up 6.22% from 2019. Although expensive, about 20% jump in total borrowing, corporate borrowing in the same period indicates the debt is less expensive than the company's existing debt was. As AMC begins to return to normalcy, I expect to see it recover from a highly healthy interest coverage ratio. Before the pandemic, AMC's interest coverage was merely about 5, meaning the EBITDA could be used to pay off its interest 5 times over. A mere 6% increase in interest expense means AMC should be able to cover the important metric with general ease. Essentially, what this demonstrates is AMC should be able to fully cover its interest expenses with operating revenues as soon as next year. So with the risk of defaulting on future interest payments looking pretty low, the only major risk of the company's questionability is ability to pay off its debt upon maturity. I don't mean to downplay the importance of the risk. Let's take a look at AMC's ability to return print. This is a long-ass article. The company took on a lot of debt. The major component Mr. Aaron highlighted was the presence of debt is not necessarily a bad thing. Of course, high debt loads such as AMC aren't exactly healthy. With the return of profitability soon as next quarter, AMC's operational health is rapidly improving, so it can update its debt position. Attractive bond offerings. I have found 4 high-yield bonds that I believe offer the best investment opportunities, courtesy of FINRA. Interesting. Typically, high-yield bonds are risky investments in order to convince creditors to lend money for a substantial reward. However, I agree that AMC's dramatically improved cash position, its bonds are unjustly discounted and offer a strong investment opportunity. So here's a high-yield bond. It has a maturity of 13.6% with a coupon rate of 5.75%, paid semi-annually. The appeal isn't so much passive income, but the overall yield rate. Now, at 5.75% annual coupon isn't too shabby, but 12.81% yield maturity is what grabs my attention. Assuming my above analysis is true, AMC will pay off its current debt. The yield is pretty strong. It does carry the highest level risk as unsecured note. So it's going through different types of bonds. Investor takeaway. By no means is the article endorsement of the stock. Bullshit. Bull crap. I'd rather agree with the general conclusion that the company... No, not stay away from it. But I do want the reader to take away from this. I believe AMC's cash position, although weak, is suitable to cover its debt obligations, and that high-yield bonds are now rather attractive because of this. While the security largely came at the price of heavy dilution, this is not a concern, as the investment thesis isn't really concerned about the share price. He goes more and more into this, different bond details. And he's talking about his EV supply chain, all that stuff. So, yeah, it's pretty... I think he's making the case for AMC. He doesn't want to say it. But I think the debt, paying down debt and better cash flows would help the stock price and would destroy the short thesis. The shorts keep yelling about the debt of AMC. The debt. Well, they could pay it off now, right? At least going into the next year. That's why these pension funds are buying it up. Nancy Pelosi's husband's buying it up. California pension funds buying up AMC because they're going to be able to pay off their debts, return to cash flow. We're going to get through this Omicron variant of COVID. We're going to get through this, and they're going to keep hammering out these high-hitting movies in order to strengthen the company, destroy the short positions, and I think at a certain point, if AMC were to hit $100, something along those lines, then the shorts could be really destroyed at that point. And then, not financial advice, but it's kind of what I'm thinking about it. So let me know, comment below what you think. Here is also another little secret to AMC. Days to cover is at 1.72. The highest it's been since January 11, 2020. That was before the first squeeze. Roche Capital, days to cover on the short positions is 1.72. 1.72 days. Anything above 1 day is kind of severe on the shorts. The highest it's been since January 11. So this is higher than what happened in May. So, I don't know. It's pretty exciting in my view. So days to cover and paying off debts. We just, however long it takes. Because if you have a certain investment, not financial advice, but after a year, you're in the long-term capital gains taxes, not short-term capital gains. So you're going to make more money. I'm willing to wait. I'm willing to wait for however long it takes. Not financial advice, just my opinion. So let me know what you guys think in the comments below, and let's figure out some awesome investments to make a lot of money. Later.